everyone. I'm Meghan Pinchuk here with Jeff Sardi at Morton Wealth. It is Friday, April 4th, and the reason I'm giving that context is that markets are rocking and rolling, and Jeff and I are here just kind of dive right into it, talking about tariffs and what's going on with markets.
Yeah, a lot going on in the markets. Today, as we're recording this, the S&P 500 is down about 5%. That's after yesterday was down about 4.5%. And as we all know now, this is related to the news around tariffs that were announced on April 2nd. And the purpose of this podcast is to not talk about the merits or downsides of tariffs. I think
we've gotten into that. Yeah,
we've gotten into that past. It's really more about clients are asking questions about their portfolio. They might have concerns, how their portfolio is constructed, how vulnerable their portfolio is in this environment. So can you talk about that?
Yeah, I can't stress enough. It's very important in the way we think about it to just be positioned in advance for volatility.
Yep.
So this isn't something where you can react, at least in a worthwhile, efficient manner after you start getting the volatility. I really think it's something that we have been thinking about. Uncertainty. What does that mean? Related to tariffs, related to debt, related to valuations, all kinds of things. So with that heightened uncertainty, how do you want to be positioned in the event that things like this happen?
And the main aspect in terms of how we're positioned with those concerns you mentioned, it comes down to stock exposure more than anything else. We'll talk a little bit about diversification, but stock exposure as a starting point, can you talk about how clients are typically exposed to the stock market?
Most firms, if they only have stocks and bonds as options, you might have, even for a relatively conservative client, you might have, call it 50 to 80% of your portfolio in stock. So again, that might be considered relatively conservative.
Drastically different than our approach.
Completely different.
Yeah.
I'd say when we look at our average client overall, it's probably closer to 25% of the portfolio. And that's a big range. We have clients with meaningfully less, with meaningfully more, but it's just because we have all these other tools, it just doesn't have to be as big a position in the portfolio.
So even to just put that number in context, I think clients should, if they're concerned about risk in their portfolio, they really should look at their stock exposure. So let's say a client has 25% of their portfolio in stocks, and let's say stocks are down about 10%, then that component of the portfolio your portfolio will be down about 2.5%. Now, the important aspect is you have 75% of your portfolio in all sorts of other things.
What's the rest of it doing?
So can you talk more about that? Because again, we have lots of other asset classes in the portfolio.
We do. And so to try to keep it high level, broad categories, I think one thing that's been really impactful for us this year is our gold exposure.
Yeah.
And it's fairly significant, again, especially relative to others in the industry. Gold's up meaningfully this year.
Yeah, up like mid-teens percentage-wise.
And then we have a little bit of that, and even in gold mining stocks, which are up even more. But that allocation has been very powerful this year in terms of offsetting certain losses.
Can you talk, even just going back to stocks, we don't just have U.S. stocks, but we have international stocks, and the diversification benefits with that?
Yeah, so there's times where we think of U.S. and international stocks as being something of diversifiers. There's definitely times where
they move together.
Yeah. And so I think we don't quite count on that helping in terms of always being an insulator on the downside. This period, it happens to have been helpful so far this year. So international stocks, while U.S. are down meaningfully, international are about flat.
In recent days, they've gotten hit.
Yes.
But even despite the hit in recent days, year to date, international stocks are flattish.
Right, despite the S&P being down
12 or 13
at this point. So that's a big difference. That's actually been really helpful in portfolios because a decent percentage, we have more in U.S., but a decent percentage of our allocations to stocks are in international. So there's pieces of that are definitely holding up better than the broader market at this point. And then now thinking more on the credit side, that's more equities or stock, and then thinking more on the credit side, bonds funds are doing fine, up 1 or 2% on the year. And it's tricky being early in the year because ideally, if things kind of go as planned, that continues to accrue throughout the year.
Right. So that's not an annualized return. That's just a return on bonds over the first 3 months or so.
Exactly. That's just for this short period of time. So if we were having this volatility at the end of the year, you theoretically have more return on the bond side to help cushion things. And you'll get there throughout the year. Same with private lending. So private lending now is a big allocation for us across a number of different asset classes. And that's up, call it 2 to 3% typically for that first quarter.
Yeah.
And not that if the world continues to have issues, recession, all those things, not that these asset classes are completely insulated, but they should be different, right? And that's the real point of true diversification is something behaves differently. They're not moving in lockstep on a day-to-day basis.
I'm glad you kind of walked through high level of those various asset classes because stocks are one of truly many asset classes. Those other asset classes are not just rounding errors in client portfolios. Right. And again, every client portfolio is going to be different depending on their risk profile. But throughout most of our client portfolios, you can see that our portfolios have really held up well year to date, given that diversification.
Many of our more conservative client accounts have meaningfully more in private lending, as an example, in bonds than they do in stocks. And so those are just going to be a lot more insulated. So again, clients are going to see the headlines. You're going to see some of these challenges, and that's not the whole story. So that's just the important thing to keep in mind is the stock market and how that's impacting. It's not that it won't have an impact. It's just that that's not the whole story.
So diversification, it's something we talk about so much. I think just even going back to the philosophy around why we diversify so much, it comes down to uncertainty. And this is such a perfect example of an uncertain environment that we currently live in. The world knew that April 2nd was coming, that these announcements were coming. We were all theoretically prepared, but still, even with the knowledge that those announcements of tariff policies were coming, the market's still dropping after those announcements. You can't prepare for these things in advance.
You can't too, because some people it's easy to, Monday morning quarterback, look back and say, okay, well, you knew this was coming. Why didn't you do X, Y, Z? And again, we are prepared. So less us, but even generally, I would say you didn't know if let's say the tariffs had come in at a lower level than the market was expecting, this market could have rallied meaningfully. And so that's part of when you have this type of uncertainty in the market, it's very unstable. And there's you could have big rallies upwards, even from here, right? We know Trump could pull it back in terms of this could be more of a negotiating tactic. He pulls it back and all of a sudden the market takes off. So it's very hard to predict that. And to be honest, we just don't really try.
Along those lines, again, we have a very different approach to how we treat uncertainty. We embrace it. Very different than most firms or Wall Street at large. What do they try to do? They try to outsmart it, outpredict an unknowable future. And I'll just quickly highlight an analogy I used in years past, and I think we shared with our audience. It's around the ocean and waves being inherently unpredictable. That's like the markets or the economy. How most investors, Wall Street at large, handle that uncertainty. It's the surfing analogy. They hone their craft around surfing, timing the perfect wave, when to get on or when to get off. Perfect example, my inbox right now, my email inbox, it's flooded with Wall Street firms talking about which sectors are going to benefit or be hurt by these tariff policies, which countries are going to benefit or be hurt by these tariff policies. And to your point, that's such wasted energy because Trump might change these policies a week from now. So it's, again, misplaced energy that I think they're trying to outsmart an unknowable future. Our approach is very different, right? Instead of trying to surf the waves, we throw that surfboard off to the side. And when you're thinking about your nest egg, we build a bigger boat, right? We build a big, resilient boat.
And I think, again, we're seeing that now, and it's a short-term period, but just knowing that is the philosophy and leading into it, the portfolios are positioned that way.
So listen, we're monitoring this closely, but big picture, we really feel very comfortable and confident with how the portfolios are currently positioned. But we're obviously watching all these things closely. And in the meantime, please don't hesitate to reach out to your Morton Wealth advisor if you have any additional questions. Thanks.